Welcome to Alternate Universe webinar series. I'm Akshara Menon from PMS Bazaar, and it's a pleasure to have you all here. In every episode, we bring fresh industry insights straight from the experts, and today is no different. Our topic of our discussion is catalyst for the wealth management industry in India. Promises to be an insightful discussion on the key drivers shaping the future of wealth management. Now let's welcome our esteemed speaker for today's session, is Ganashyam. Ganashyam is a seasoned leader in private banking and financial services, bringing over 3 decades of experience in portfolio management, investment advisory, and multifamily office services. As a managing director and co-CEO at Spark PWM, he plays a pivotal role in shaping the firm's strategic direction. Having held leadership positions at Centrum Wealth, HSBC, and Anand Jati, his expertise in wealth management, financial planning, and risk management has positioned him as a trusted advisor to ultra high net worth clients. Chartered financial analyst from US and postgraduate in management. He has been instrumental in driving innovation in wealth solutions while mentoring the next generation of wealth managers. Joining him today, we have two moderators for the day. Mr. Vikaas and Sachdeva, industry stalwart with over 3 decades of experience in asset management, and currently serving as managing director at Sundaram Alternates, where he drives the growth across platforms, geographies, and asset classes. Moving to the second moderator of the day, Mr. Vaatsal is a financial service professional with over nearly 12 years of experience spanning in investment banking, investment management, and corporate banking and credit structuring. Having worked with JM Financial and Accra FinCap, he has been instrumental in deal sourcing, underwriting, and managing portfolios that have consistently delivered strong returns. So I want to welcome all three of you to the show, sir. With that, let's kickstart for today's session. Over to you, sir.
To welcome Ganashyam. Welcome Ganashyam to the show. I've known you for years now, and I think probably this is the first time we're actually getting down to sitting down and chatting about the business at large. We've talked about business, our own businesses at length, but this is the first time we're talking about stuff like this, in terms of catalyst for wealth management. And I'm really keen to hear your views. In fact, Kancham, close to 500 people, in fact, more than 500 people have actually registered for your show. So I think this is not just a topic of interest to a lot of people, but they want to hear you considering your illustrious background. Uh, so before I start, I must also share with you, we have this section called Person Behind the Professional. Gansham, we spoke about you. We tried to find out some information about you from your colleagues, your current colleagues, your ex-colleagues. Very, very difficult to get information on you. But I must tell you some of the findings which we got about you. Your team actually, what is the word I'm looking at? Respects you a lot, is in awe of you, loves you a lot. I think it's a blend of all of three. There's such a word. I asked them, what describe Gansham to me in a few words. So the words which came across were thoughtful, mindful of what he speaks. There is never a word out of place. And knowing you for so many years, I realized where they were coming from. They look up to you as a very strong mentor because you are one of those people who will take colleagues along with you. You will say, let's do things together. Not just that, one of the key things they like about you is a very structured approach to problem solving, which you bring to the table. Uh, they believe that it helps them have a very pragmatic conversation with you and look at the problem for all angles. So, this was something which I found very fascinating. What I did not hear, which I think I know now, is that you've got a damn delicious sense of humor. So I think that is something I didn't pick up. I guess your professional phase is far more serious than your personal one. But one thing I didn't know, you're a very avid movie buff. You enjoy classic Hollywood and Bollywood movies and light comedies. Now that I can relate with. You're an avid reader and you like to read ancient Indian wisdom oriented books like the Bhagavad Gita, the Yoga Vashishta, the Patanjali Sutras, and not surprisingly, contemporary stuff on finance, economy, and market related topics. Not just movies, your love for music is also classical, pun intended. You are so much in awe and you respect artists like Bhimsen Joshi, Kishori Amonkar, and Pandit Jasraj. So much so that you've taken upon yourself to learn classical Indian music yourself, vocal classical Indian music yourself. Now, this is something which I didn't know. It was very surprising for me. You like traveling, you like exploring cultures, historical sites, and spiritual destinations. In fact, you were very deeply, impressed, intrigued by your recent trip to Japan, and you share insights of what you learned there in a lot of conversation with your team members and clients. You practice Vipassana meditation for mindfulness. This is something I've never been able to crack, so I'm going to come to you and get a few tips on this. I was asking about your fashion sense, and they said he's a very simple man. He loves simplicity over designer labels. Usually, you will find him, his comfort dressing is basically white shirts with black chinos or gray chinos or trousers, and I think, and you'll end up exactly like that. You're a vegetarian. You have an interest in diverse global cuisine. Uh, Having said that, what was a surprise to me was your very high tolerance to spicy food. In fact, so much so that you enjoy incorporating fresh green chilies into meals. Somebody has been at the receiving end, I guess. Your better half used to be a banker and is now a homemaker. Your son is in grade 12 and he aspires to study engineering in an IIT or a global equivalent of an IIT. He's studying very hard to do that. So, Gansham, once again, warm welcome to the show.
Thank you very much, Vikas. And I'm extremely grateful to you for having thought of me to invite to this show. The 500 registrations is more the popular quotient of the show rather than me as a guest of the show. And thank you for having made the effort to sort of talk about me. And I'm also grateful to the people who sort of contributed to your polling. Much of what they say is extremely kind, and I don't think I deserve much of that.
No, Gansham, you're very, very modest. You're in your comfort zone when you're modest, and I'm going to push you out of your comfort zone with some questions. People have been writing in, asking me questions, so be ready for some of the questions which are coming across to you. But I guess you will be able to look at things from a holistic perspective. You've had a illustrious career across marquee institutions. You've been shaping and navigating the virtually the evolution of wealth management in India. As a seasoned leader in this space, uh, what have been some of the most profound insights along this journey and transformative lessons that have influenced your approach, that have evolved your approach in terms of wealth management to HNIs and ultra HNIs?
Of course, because as always, you're extremely kind in the way you have introduced this question. I don't think much of what you said is deserved. It's just that I spent long years in this business. And I'm fortunate to have seen the evolution of this business and a very rapid evolution in the last few years. Several learnings, several lessons, some easy, some very expensive. Uh, and there's also a significant amount of received wisdom that I have in terms of whom I read. To answer this question, I will sort of take a cue from somebody I really admire. He's a seasoned investment professional and also a professor in Columbia University. It's a French name, therefore I'll not try and hazard how to pronounce it. But essentially, one or two insights to begin with. One is that we are in a profession that deals every day with outcome. There's significant outcome orientation to this business, and therefore a huge sense of responsibility in terms of sort of creating, managing expectations, and delivering outcomes. Second, these outcomes are in a significant context of uncertainty, and uncertainty in this business is powerful, of course. But we need to act and take decisions in this uncertainty. And therefore, it's a huge opportunity to sort of take all the information that's available, the research, the insights, the wisdom, and convert that into outcomes for comfortable client experiences. Third is when you're talking of uncertainty, people get fixated on a single outcome, whereas there are probabilities to outcomes. So I prefer to work with scenarios and attach probabilities to the scenarios rather than getting fixated on a single outcome. Now, talking of outcomes, you're trained to think long term, but the journey to long term is a series of short term experiences. And much of what you believe in and much of what you put out needs to be validated on a more regular basis. But that's what you need to reconcile as a wealth manager, the short-term pressures versus the longer-term journey, which eventually will be good. Uh, it's also a significant conflict in my mind at various points in time in terms of wealth management as a profession versus wealth management as a business. Here, for me, it's very important to sort of look at the discipline that needs to go into process, the way things get diligence, the things that get put out, versus the short-term pressures of what works and what sells. And that's a conflict that I'm constantly trying to resolve. The second is there is an inherent conflict in terms of we have sort of known all the years that ultimately what makes returns is when you challenge the consensus, when you're contrarian. But there are large periods of time when you have to be part of the herd and you really don't want to stand against the tornado of the herd. And then you come to periods in time when the mistakes are made, and then you sort of course correct and get back to the longer term. Finally, I think because I have come up this path through the product advisory, diligence, gatekeeping route, I'm also a CFA by qualification. I'm trained in process, I'm anchored in process. I like to sort of use process for everything from a decision making perspective. But there are periods in time when, again, you get carried away by beliefs that are contrary to what you think, and that ultimately you need to course correct again. And finally, outcomes actually process. I strongly believe that process sort of scores our outcomes. A very simple example: if you look at any price in the market, it is supposed to stand for various expectations that it sort of represents, and those expectations can be very different in terms of what you analyze from a fundamental perspective. But then still you go with the herd and sort of you try to sort of circumvent process and you come to these. Finally, I think that there is a huge courage of conviction. There is huge faith in your research capabilities. And all of this brings in a level of arrogance, which is dangerous. There is also the comfort of the status quo that you sit in because you work with time-tested processes. And there is innovation happening every day in the market. Nobody has any monopoly on ideas. You need to have the open-mindedness and the humility to sort of be sort of receiving those ideas, assessing those ideas, adopting some of them, and discarding many. So these are, because in a long journey, something that I have lived with and something that I use on a day-to-day basis.
It's very interesting. Thank you for sharing that. In fact, I think our jobs, and particularly your job, becomes that much more difficult because there's so much of noise around us. I don't know whether you would agree with me, but sometimes it is more difficult to fight the noise rather than perception, because noise makes perception reality. It just
Very
gets
true. Very
difficult.
true. Very
Yeah.
true.
I'm also seeing this, in terms of generational shifts in investor behavior. Having seen one or two or three cycles, and generations turning in, most people are now seemingly looking at shifting from, say, traditional asset allocations to more dynamic and bespoke solutions. Okay, I'm just picking up a thread or two from where you lived. So, what's the one thing wealth managers need to unlearn, to stay relevant in the current scheme of things?
It's very true that there is a very large component of next gen in investment decision making, and they are exposed to trends and situations which are very different in terms of the longer term experiences the previous generations have had, even people like you and me have had. But I still think, when I deal with them as part of the families that they represent, there is still a significant amount of merit in traditional asset allocation. And when I say that, it is essentially about profiling yourself, getting into risk return frameworks that you are comfortable with. And then based on that framework, working out your strategic asset allocation may sound like a lot of jargon, but it can be demystified in conversations, and I'll not waste everybody's time to sort of go deeper into this. And based on the assessment of your own investment objectives, your own investment horizon, your own investment familiarity or circumstances, you are alive to market circumstances, and you work within tactical ranges, and you keep calibrating the tactical ranges to really take advantage or to really sort of benefit from what's going on. And you end up making mistakes, and you end up getting carried away, where you will sort of breach those buckets and end up getting overexposed or underexposed to certain asset classes and product categories. You can weave in a lot of the contemporary, you can weave in a lot of the dynamic based on the evolving markets and product categories. And all of them, I think, fit in very beautifully, if you really see at the end of the day, into the traditional asset allocation framework. I just illustrated with one example, which is a public equities asset class. I have believed over the years that ultimately, over the longer term, one needs to at least get the return of the asset class over a longer period of times, and hopefully try to better that. Evidence is increasingly mounting that it's very difficult to sort of now to beat asset class returns over long periods of time. But still, in India, it's an active manager market and it's an active orientation market. So if you were to look at laddering that portfolio, I strongly recommend that you start with passives and a large dollop of passives to not stray away from the asset class returns. Then you get into what I call semi-actives, and products that I'll talk about are active products, but products which are very diversified, which give fund managers the flexibility to go across caps, across sectors, make contemporary investment decisions. Flexi cap funds, for example. So between the flexi cap or that semi-active part and the passives part, I think 50 to 60% of the public equities portfolio should be anchored. Then you bring in the active component, and you can start very well by identifying trends and shifts and use baskets like in ETFs, whether it be sector baskets, whether it be cap baskets, whether it be factor baskets. You can even get into mid cap and small cap and look at active management over here. You can use PMS managers for doing concentration over here. You can do your own bespoke equity portfolios with or without advice or in the NDPMS formats. And even you can carve out a sliver for trading if indeed it interests you and you think that you can sort of. But the risk needs to be sort of ring fenced in each such category, because finally, when the cookie really sort of adds up to the overall level, you should have met the asset class benchmarks or beaten them. And this is a process that you can use in fixed income, you can use in alternatives. Therefore, I don't think that traditional forms of asset allocation or the traditional concept of asset allocation is dead or is sort of passé. It's just that how you blend in the new and the dynamic and the bespoke into the asset allocation frame.
So this is really insightful. And just was intrigued to know. Now, while we spoke about the allocation bit, I wanted to know from the wealth manager perspective. Traditionally, banks have been the wealth managers, the biggest sort of wealth managers, and now we're seeing these boutique investment specialists like your firm, the likes of maybe Motilal, Levendus, and the sort of new age wealth platforms like Deserve and all. So, I mean, the question out here is, what do you feel each of these sort of between banks and boutique wealth management platforms, each of them have their own competitive advantages, and where do you largely see them sort of panning out in the next decade? So, what is driving this shift? Are you seeing a loss of wallet share? Are you seeing each of the sort of platforms having their own AUM respectively? How do you see it panning out now and over the next decade?
Very interesting question, Vaatsal. I had the good fortune of working in large formats for a long period of time, and I had the good fortune of working for the last 12 to 15 years in boutique wealth management firms. If you look at the traditional formats, which are essentially the large commercial banks, the very large investment banks, and the very large securities firms where all the relationships are anchored in wealth management, I think there is the huge advantage of solidity. There is a tremendous amount of focus on delivering wealth management at scale, which involves process, risk, and control. And I had a very good experience of that when, for a very large format, I was part of the team that was setting up wealth management. And we had to spend an extraordinary amount of time with colleagues in the Asia Pacific region and in the UK to really sort of look at the way their models have been engineered over time and what are the best practices that we can adopt to sort of set up this thing in India. What I really loved and benefited from in all of these interactions is that there is a tremendous emphasis on making sure that the processes are aligned for both structuring the proposition, diligencing things that come into the proposition, and delivering it at scale without making mistakes. And if it means that it takes time to sort of, go through a few iterations, but getting it right and then zero tolerance for error, that level of engineering is very good from a client perspective, and the chances of errors or significant sort of mistakes is minimized. Has a significant amount of value, and there are many customers who like the benefit of being part of a large institution, and they also like what's called we call the badge value, meaning I am this bank's customer or I'm this investment bank's customer. But be that as it may, you've seen over the last few years a number of boutique wealth firms that have carved a niche for themselves, some names that you took, and are extremely well regarded. If you look at the origins of these boutique firms, these are essentially offshoots from the larger formats, leadership and senior team members having spent years there and been very successful. Long-standing client relationships that they've been able to onboard, that they go very long in time, very intensive understanding of client requirements, and more importantly, a very solutions-oriented approach rather than a product approach in terms of the way they engage with clients. So if you really take it a little further, they make it so relevant that not only areas of core wealth, and that area itself is expanding dramatically over time, but you're also looking at areas that are adjacent to wealth, investment banking, legacy planning, taxation, valuation, family business advisory services. So for a client, it is about his requirements and looking for solutions and delivery of solutions from the boutique firms. And the beauty is that they're able to combine the solidity which large formats have, because many of them have spent time in large formats. They understand process, they understand scale, they understand risk, but they bring the entrepreneurial energy, the agility, and the solution orientedness of an emerging company. So therefore, I think you see it in many other sectors. You see it in law firms, you see it in investment banking firms, you see it in advertising agencies, you see it in fund management, and they're very successful boutique firms that operate in this place. Even internationally, I think this trend is catching on, and there are very well regarded boutique wealth firms that have come up over the last few years. So going forward, I see a space for both the solidity, and I see organizations go through challenges, but I'm very confident that the traditional formats will re-engineer, rediscover themselves. But the boutique wealth firms will have found their niche, and they'll keep growing this niche and continue to grow and thrive.
Okay, so I mean, there's room for everyone.
Absolutely. It's not one versus the other, it's one and the other.
Understood. I had another related question. I mean, if you can just maybe talk about your experience of building up the business, wealth management business at Spark. What has been your journey like? What have been the key challenges? What have been the key learnings and drivers? If you can just share some insights, that would be great.
Spark has had its origin as a boutique firm 20 years ago. A bunch of professionals, successful professionals, got together and founded it. Has its origins in investment banking, with a very strong belief that the promoters have even today, that it has to be a business based on knowledge, based on intellectual rigor and research. And that's how that business over a period of time has come to be extremely well regarded with their entrepreneurs they work with, and with the investors who dealt with them. And also through that business, they've built a very good understanding of how businesses function, how businesses grow, and therefore an understanding of private markets. They then ventured to get into what's called institutional equities, and from being an upstart firm, they rose rapidly to be rated among the best in terms of quality of equity research, macro sector, and securities. In almost every fund manager survey, they've been rated among the top 3 are the best. That gave them a very good understanding of the public equity space. They combined both of these understanding into the asset management space, where today they have successful products in the public equities asset class, in the private credit asset class, and now the private equity asset class. They decided to focus very significantly on wealth management about a year and a half, and they've committed significant investments to the space, and that's the reason why I'm here. Over the course of the last year and a half, we're now a team of over 400 people across 12 locations in the country. The most recent locations being Lucknow and Kanpur in the north, Kochi and Trivandrum in the south. It's an integrated investment banking, wealth management, and asset management model. The reason I say that is that we have embedded an investment banking team within the wealth business to cater to requirements of clients. The teams that have come together, many of them have spent time working together for at least 10 to 15 years. So there's a great deal of camaraderie. We've been, God's been kind in our ability to integrate disparate teams that have come together, whether it be on the product and fund management side, whether it be on the operations and technology side, whether it be on the sales and coverage side. Over the course of the last 1.5 years, we also had the benefit of the tailwinds of the markets. We've been able to grow assets to almost close to 30,000 crores over a 1.5 year period. And therefore, the experience has been very good. We've been able to embed a great culture, and we've been able to get a great level of acceptance of the proposition from customers, both in terms of they coming on board and increasing their share of wallet with us.
Vatsal, if you don't mind, can I ask him a couple of questions now? Now, I was listening to you, Ganashyam, and again, your coming to Spark 1.5 years ago was a proverbial spark lighting a fire, right? So your boutique fund house, 400 people. I was completely taken aback. I didn't expect this. 400 people is very, very good, yeah, in a year and a half. I was just reading an article recently which talked about the fact that family offices today are actually the catalyst of what modern wealth management. And that set me thinking. Because multifamily offices are playing a very pivotal role in institutionalizing private wealth. Uh, how do you see their role, multifamily offices' roles, evolving beyond just structuring and portfolio management? Are they becoming investment houses in their own right? I just heard you talk about a few of these things, so I just thought I'll pick this thread and delve a little bit deeper into it.
Uh, Very good question, because just today, to get started, we're all aware of a data piece that's doing the rounds in terms of the number of family offices in this country having gone up 6 or 7-fold in the last 6 or 7 years. There's stupendous growth. We know that a significant amount of wealth creation in India has been on the back of family-owned businesses. And these businesses, when it comes to the families, have been professionalizing themselves and also institutionalizing processes. And for many of these families, the source of wealth, still a large component of it comes from the businesses that they run. There are very serious deliberations and discussions around perpetuity for both the family and for the business. There are discussions around ownership and management. There are structures that are put in place for the family, which could be a family council, a family business board, family trust. There's a formal and a structured family constitution that binds it all together. So there is a lot of method and a very rapid pace of evolution that's happened in this space. And when it comes to family offices, there are largely three types of family offices: the smaller ones, the mid-sized ones, and the larger ones. When you deal with the larger family offices, they have been able to build great teams, extremely competent teams, and we've been doing this for a while now with great track records. For the small and mid-sized family offices, they look for support because they are in the process of ramping up their own competencies. But there are obviously challenges in terms of attracting and retaining talent and sort of getting them aligned to family objectives. That's where the multifamily offices come in. Four broad areas that they sort of deliver great value on. First is obviously investment management, right from setting up the investment policy statement to portfolio construction, diligencing products, interface with product and service providers, interface with external wealth advisors, administration, execution, portfolio consolidation, and finally sort of managing the cash flows. The second area where they're able to deliver value is in the area of estate planning, which is about sort of protecting and furthering the legacy of the families. Taxation is a very important element because it's complicated and it's getting more and more complicated. And when there are businesses or family members who have an overseas sort of residence or jurisdiction, those are also considerations that are important. And the multifamily offices are able to access networks, whether it be accounting firms, whether it be law firms, in sort of providing a turnkey solution on the taxation side. And there are various ancillary services which could be as simple as investment banking to as complex as family business advisory services with valuation, residency planning, and all of that. So I see multifamily offices over a period of time building strong domain capabilities in each and more of the areas that I'm talking about, and actually adding sheen to it by partnerships and associations and making all of that available to families. Their engagement with families, officers have only grown over a period of time. And I think they will soon attain an institutional character and will become, as you rightly use the term, investment firms in their own right.
Very interesting. In fact, I was listening to you, and Sundaram Learning and Information Center has actually come up with a report on family offices. This is a report which has contributions from family offices themselves. And I'd just like to tell the audience, if you're interested in knowing more about it, you can actually download it from our website, sundaramalternate.com. You know, quite a bit of interest has come in, and I'm very happy to hear you say that, because some of these challenges which you talked about are really big challenges these family offices are facing at this point of time. And I'm glad there are outfits like yours which are helping them out. So one of the things which came out in the report was the investment and the risk appetite of first generation wealth creators. Especially entrepreneurs from the technology and D2C brands, direct to consumer brands. How does the risk appetite and investment philosophy of a family office which has been created by an entrepreneur in his own vision differ from that, say, of a quote unquote traditional monolithic family office structure? How does it differ? If you can just give us some insights into that.
Well, because all of us know that when we deal with those young entrepreneurs, you're dealing with some extraordinarily competent, talented, high energy individuals who've been able to, on the power of their ideas, structure it into a business, scale it up, make it profitable, also monetize it. So very, very high energy, extremely driven, but I find them very short on time. Money, very beautifully for them, is just a number and an outcome. The runways, both in terms of professional and entrepreneurial, is very, very long. Many of them are scaling up what they're doing, or probably they're in the next leg of the entrepreneurial journey. So, since the confidence in their own capabilities or their confidence in terms of understanding, assessing, and structuring things is so high, the level of risk taking is very high, and that's very different from traditional families. They are very mentoring. They love to support new ideas and ventures. They back it up with their own time and with a lot of their money. And if you see a typical portfolio of some of these individuals, there is a whole list of companies from very small amounts to very large amounts that they have, and they're very proud of it. And with a smile on their faces, they know of the write-offs that they have to take, but they continue doing it because that's their passion. When you look at typically the way their portfolios are configured, you find that there is a fixed income component, which is really the safety, security, liquidity sort of component, and that gets reviewed over a period of time. It's essentially the peace of mind component. Very, very significant investors in public equities, and because they're extremely informed, very, very well aware, they have very strong views. They work with a host of products and fund managers. They have preferences, and they sort of play it through the way they agree to choosing products in the portfolio. But the most beautiful part is the private part, where they are in the ecosystem, where they're dealing with established entrepreneurs, emerging entrepreneurs, and they want to put their money where their mouth is. They also are interacting with a lot of money managers who take interest in them and who have conversations with them, who probably pick on their expertise and experience to sort of also diligence other things. And therefore, these guys have a very good sense on who good and who not so good. And you can find that again reflected in the portfolio in terms of the choices that they make. Therefore, very, very different from the way traditional family offices work. And it's very, very interesting. And you end up not only sort of helping them, but more important than learning from them in terms of the interactions that you have.
I remember this ad which comes on television. "Ye Naya Bharat hai. This is the new India." Just I could hear echoes of what you were just saying in that. It's
Yeah.
so amazing.
It is just when I talk about it, I feel so happy and excited to talk about the way in which you can engage with them. And it's very, very insightful, every single engagement or conversation you have.
Ghanshyam, before I pass you on to Vatsal for the next question, I was just thinking that I think our generation has been the most blessed one.
Yeah.
We've seen landlines to now Wi-Fi,
That's
and
it.
we've seen traditional business families to these amazing entrepreneurs. I'm just getting goosebumps just listening into you. Amazing.
Exactly the feeling I had when I was talking about.
Wonderful.
Great.
Vatsal, over
So
to
just
you.
taking, yeah, just taking a cue from there, I just wanted to know how do you basically think about asset allocation on the alternative side, given that we are seeing a lot of dry powder as well on that front, as well as a lot of interest and investment from family offices, HNIs towards this. So how are you seeing the allocation in private equity, say private debt, venture capital, real estate? How is the alternate universe according to you shaping up? And I mean, where do you see it, say, 5, 10 years down the line?
First, Vikaas and Vatsal, you are in a very exciting space, and I feel very envious of you in terms of what you guys do and the opportunities that you look at. Well, the numbers are there from the time the AIF regulations have come into the country from 2012. Today, at 13 lakh crores, it's not a small number in terms of cumulative commitments as on 31st December 2024. Almost close to 20% of the mutual fund industry asset size. Cat 2 at close to about 11 lakh crores. It's just phenomenal in the manner in which this industry has grown. But I was also looking at some international data, a recent survey of global family offices. I was amazed. The average allocation to alternate assets in family office portfolio is as high as 45%. And that is a staggering number. And areas like private equity of the families surveyed, and it's a very large number of families that got surveyed. 85% of the families invest in private equity, only next to public equities. So it's both a trend in India and overseas where alternative assets are becoming very, very important. Even if I had to look at it the other side in terms of this industry being providers of capital to both industry and entrepreneurs, there is a great niche that they sort of come and fill. And if I had to just take the example of private credit, if you were to look at the traditional bank, NBFCs, the mutual funds, the international institutions, the manner in which they're able to understand entrepreneurs and understand businesses and work out structures with flexibility. And Vatsal, I can see you smiling, the role that you do. It's amazing. And it's only growing very, very significantly. So from an investor point of view, you have obviously, if you have a longer time frame and you're willing to live with illiquidity, and you're willing to extract the premium for illiquidity, that is a great manner in which you can build an uncorrelated asset class into your portfolios. Public markets, because they are discovered, if we do believe in efficient markets, then there's only so much that you can get in terms of trying to either the beta or the alpha part of the market. And in fixed income, we've seen over the course of the last 5 years, traditional fixed income, it's been depressed yields. So therefore, the interest in alternatives is very, very high. And I see it in private equity, whether it be the early stage, the growth stage, or the late stage. The fund management industry has come of age. Fund management practices and governance processes are extremely solid. Track records are now available. In the private credit space, right, go from performing credit to special situations to real estate to venture to real assets infrastructure, meaning it's got a huge menu out there in terms of picking and choosing. And I think investors are getting more and more comfortable, and the delivery from managers in terms of track records is very high. And I see the trend happening both in terms of fund investments and the conviction and the trend towards sort of participating in co-investments or doing direct deals on their own. So this space is here to stay and is going to grow in a significant salience, which I think is great news for both of you.
Wow. So if I can understand and summarize, there are some offices, family offices that are sort of allocating as much as 45% to
Internationally,
organize events.
internationally, average is 45%.
And maybe what would be the Indian average in this?
I Okay, we started with the rule of the thumb, 10%, 15%, both of us. But today I see 20, 25, meaning portfolios where about 25 to 30%, even a third in alternate assets. Obviously, a range of products and managers and securities. It really is a function of how the investor has started on that journey, the
Mhm.
type of payoff that is seen. Obviously, there have been a few unfortunate experiences in the past. So those investors, it's like, two steps forward, one step backward. But eventually, I think it will come to sort of occupy a very solid place in portfolio.
Okay. And see, yeah, so one more related question. We are seeing an increasing trend of a lot of family offices wanting to either become co-investment partners or like co-anchors, co-GPs, and basically have more skin in the game, have more probably say in the calls that are being taken, and not just being in a passive role just as an investor, but more of an active role. So you as a wealth manager, how are you seeing this trend? How do you advise your sort of clients on the risk as well as on sort of this strategy bit from your perspective?
Brilliant question, Vatsal, and it's really a very sort of active area of interest for everybody in this business. Let's take the traditional investments and let's take public equities as an example. We've gone through a huge phase of evolution where HNIs and family offices have worked with mutual funds, have worked with PMSs, have worked with alternatives. And today we see many of them having developed competencies and capabilities as well teams to assess and diligence securities and sectors in public markets and building portfolios of their own with inputs and advice and also possibly in the NDPMS format. The trend, similarly, we are seeing in private equities. So to the question on how wealth managers can do it, that's the reason we have embedded an investment banking team within the wealth management outfit. And the whole objective or the key areas of this team is to essentially work with clients and also help source, diligence, curate, and place deals on the direct side. In terms of the way I see it going forward, you will have the HNIs and smaller family offices who may be better served with funds or for larger tickets, co-investment opportunities. And even for doing direct deals on the more established, there are a few names that you're aware of where there are some established prices where trades keep happening. So you can keep sort of adding to those securities. But for the mid-sized and the large-sized family offices, where they are building competencies and capabilities, it's not easy, this space. And therefore, they need what I think is a multifamily office equivalent in terms of a partner to sort of support in areas like governance, in terms of assessment, analysis, and reporting of information, interface with promoters, interface with other shareholders on the cap table, thinking about exit plans and exit strategies. And that's where the investment banking team that I talked about that sits within is able to sort of work with families and see an increasing amount of traction that they get. And that's where, as wealth managers, we are trying to become relevant. For the very large family offices who have these very established teams and who are doing a wonderful job, they look to us for transaction advisory support or for strengths that we have in sourcing, diligencing, and placing deals. So that really is the manner in which the space is evolving and what we wealth managers are trying to do to stay relevant and participate in the growth of the space.
For
Vatsal,
these,
I just realized, I told you this, Gansham, that we will not even realize how time will go by. And yours has been a particularly engaging conversation. So we're already at 5:15, 5:16. So with your permission, can I just jump into audience questions? Some of them have already been
Yeah,
covered.
please, please,
Yeah.
please. Yeah.
First of all, I'd like to thank Kamlesh and Mrunal and Sameer and Yogesh for your viewpoints, for your questions. But despite that, you're asking some very good questions. Rajiv, you asked some questions on tax concessions and Indian industries likely to be impacted by Trump. tariff and global equity markets and the Sensex. I think we'll probably park that question for the moment. This is something I think you can get in a lot of places. This particular viewpoint, I would rather ask Ghanshyam something which is not available in most places. Ghanshyam, Maulik is asking us, what is the right to win in the wealth management business? Part A. And part B is, can you talk about the competitive scenario in this space, given that the industry is growing very fast? You've given us some insights, but I think Maulik is seeking a little bit more. He's asking very clear, pertinent question. What is the right to win? What is the right to win?
Maulik, I think all of us grapple with it on a daily basis, and I like to also sort of talk about it in light of the challenges, which I would like to sort of humbly talk about in terms of what we face. And this has been on for a while. We're facing very dramatic changes in the environment. We're facing dramatic amount of volatility. And therefore, all of us need to up the game in terms of the manner in which we are able to sort of make sense out of all of this and sort of build it into risk-adjusted sort of recommendations to customers. And in the competitive intensity, which is so high in today's markets, um, the differentiation really, or trying to stay relevant, and I can say it with the confidence, the boutique format does help because you are able to work with a specific set of customers, and you are alive and sensitive to concerns and requirements and sort of handholding that keeps coming up. So the boutique format obviously does score in a situation like that as compared to a larger format where you'll have to sort of put it through the factory shoots in terms of reaching customers. I also see that the industry has moved from product selling to solution selling or to advice related stuff. And I talked earlier about core areas of wealth, and there are many areas that you need to build and develop in the various asset classes. So if you're able to combine breadth and depth in terms of the way your coverage is, and you're also able to bring in these areas that are adjacent to wealth, like estate planning, investment banking, taxation, you're able to then make sure that your RM is no longer a person who is providing transaction support or is no longer a person who is doing templated relationship maintenance, but is the one who is actually out there trying to spot opportunities, understand requirements, and use all of those domains, whether in-house or in partnerships, and deliver solutions. And finally, the point that we haven't spoken about is technology.
Yeah,
Meaning,
that's also
I cannot overemphasize the importance, and it's there in every phase of life where the demands of technology from consumers is very high, and especially in a place like wealth management, where customers are young, the inheritors are young, very familiar with technology and want demands of technology from wealth players. And now with AI, which is trying to hyper personalize stuff using millions and billions of data to generate insights, analytics, next best actions, and all of that. It's going to be a game of AI providing not only information but significant amount of insights and next best actions to customers. And relationship managers having to stay on top of the game because it's not only providing information, it's also providing research and analytics. Relationship
mm,
managers have to demystify that, keep themselves fairly abreast of what's happening, and try to sort of explain all of that and sort of place it in the light of customer preferences and biases. So all of this, if an organization is able to do it in a boutique format or a large format, is where it will have much more of a right to win rather than working with templated business models or, for that matter, product-oriented business models.
you reminded me of this conversation I was having with a very senior person in the industry. And he
Right.
says that wealth managers are probably the most intelligent people in the industry,
Hmm.
temperamentally and intellectually. So I said,
Right.
why is that? So he says, you
Yeah.
know what? When you go and talk to a client, he's a specialist in general finance
Right.
stuff. He knows everything, something about everything. And when we
Right.
go with the solution, the manufacturer knows everything about something. So,
Excellent way of
so,
describing it.
so the wealth manager has to actually balance both of them and be on top. And
That's
I
true.
and I quite understood and I resonated with that feeling. So hats off. I think you are when you're talking about right to win,
Right.
it actually starts first with right to survive. So
Absolutely. In
uh,
fact, that's something that I lose sleep over every single day.
brilliant. Okay, and actually you preempted my next question about the role of technology, so I'll probably come back to that later.
Right.
Uh, Kamlesh is asking me about what are your thoughts on global equity allocation? If somebody has to start off now, uh, global equity allocation, not even asset allocation.
Uh, it was available to some extent in some of the mutual funds in terms of the overseas allocations, but there are some temporary constraints that we are going through in terms of limits and stuff like that. So that's something that is a constraint that we'll face for some time. But I think the LRS route, I think, is the best way to get started. And while I'll continue to have a very significant home country bias in terms of the way I continue to get carried away by the opportunity and the attractiveness of what's happening over here, dollar diversification or foreign currency diversification is very, very important. There are various platforms that allow you to do it on to sort of sort of toe the waters as you go forward and slowly increase your asset allocations. But at this point in time, the only meaningful way I can think of achieving some amount of global diversification is through the LRS route and working with platforms which are able to initially provide templated solutions. And then as the corpus keeps growing, you can sort of get into more nuanced stuff.
Interesting. We have
Because
time
if
for
I
one last
can,
question.
sorry.
Sorry, what's
And
please
yeah,
go
sorry.
ahead.
Before this, I had a very interesting. Arvind asked a very interesting question. I'm not sure if it's that relevant, but very insightful. If Ghanshyam ji you can share. So
Yeah,
his
please.
question is, if you can bet on one major disruption that happened in the Indian wealth management space, something that isn't widely discussed yet, what would that be and why?
So indeed, that was the last question which even I was going to ask. I was fascinated by that.
I think that meaning from a disruption point of view, to for the regulator to sort of move towards ensuring that all compensation for wealth managers will be linked to asset staying and sort of doing it on a trail basis or on a retention basis is something that I think has sanitized this industry very, very significantly. It has helped build models which are more now portfolio oriented, solutions oriented as compared to product selling oriented. And it's also served customers well because the advice or the inputs that come from wealth managers is all in terms of asset allocation and longer term investment horizons. So while there are many and they sound tactical, but if you really look at it from a sustainable or a longer term perspective, to try and move compensations towards retention, longevity, and aligning compensation both from a client and an advisor or a wealth manager point of view, I think is probably the biggest disruption that comes to my mind and which the industry has beautifully adapted and got used to.
I think some of the questions which are now coming in are amazing, but unfortunately, we're running out of time. I'm getting questions on SIF, I'm getting questions on PMS versus AIF. Gansham, is it okay with you if I send you across these questions
Yeah,
and
yeah,
probably at
perfect.
leisure you can answer them?
SIF is a great area, but I think there are lots of clarifications that people are still wanting to know in terms of the way the regulations are drafted, the way their teams will be resourced, the way they'll be sort of able to manage the products in terms of competence. We're almost there, but I'm still awaiting the first product to come out. But I think the regulation holds a lot of opportunity.
We have a prize for the best question, and I'm actually torn between the question which Maulik asks about the right to win in the wealth management business and Arvind asking about major disruption.
दोनों
Uh,
टाई करा दो ये both
Done.
are wonderful questions.
दोनों को प्राइज देते हैं. I think that's the best way to do it. These are absolute टक्कर वाला questions. Thank you so much, Gansham. This was really, really enjoyable. I think all of us got a lot of insights in terms of the way wealth management is undergoing a transformation and the catalyst for wealth management, which was the original topic. So thank you so much for your time, and thank you, PM Bazar, and thank you for a lovely audience. Thank you, Vatsal.